In 2025, a record-shattering 42.7 million foreign tourists flooded into Japan, spending almost 10 trillion yen. But in that exact same year, a record 397 Japanese companies went bankrupt for one terrifying structural reason. They literally could not find enough human beings to hire.
Welcome back to Asia Tech Macro. I'm Maya, and today we are looking at the ultimate macroeconomic paradox currently unfolding in Japan. Everyone sees the headlines about the weak yen driving the greatest tourism boom in Japanese history. But on the ground, the domestic service sector is buckling under the weight of severe demographic decline and a notoriously fragmented tech ecosystem.
I'm Alex, and the friction between infinite inbound demand and zero domestic labor supply is creating an absolute breaking point for the Japanese economy. The hospitality industry isn't just struggling, it's being forced into a radical, incredibly painful technological transformation just to keep the lights on.
The sheer volume of people entering the country is hard to wrap your head around. I was just reading this morning that on January 20th, 2026, Japan's tourism minister Yasushi Kaneko officially announced that foreign arrivals hit 42.7 million last year. That easily crushed the previous records. Tourists spent a staggering 9.5 trillion yen. If you walk through Shibuya or Kyoto right now, it feels like an absolute gold rush.
It looks like a gold rush, but if you look at the corporate balance sheets, it is a logistical nightmare. Because while the government is celebrating the 9.5 trillion yen injection, the market research firm Tokyo Shoko Research just released their 2025 bankruptcy data, showing that overall corporate bankruptcies hit a 12-year high. And the most shocking data point, 397 of those bankruptcies were explicitly classified as labor shortage bankruptcies. That is a record high. Hotels and restaurants literally have customers lining up outside with cash in hand, but they have to keep their doors closed because there is no one to cook the food or clean the rooms.
Wait, really? They're going bankrupt with a line of paying customers out the door? That goes against every basic rule of capitalism. If demand is that high, you just raise wages until you attract enough workers, right? That's how the market clears.
Well, actually, let me rephrase that. That is how the market clears in a normal demographic environment. But Japan's working-age population has been in free fall for 3 decades. The World Travel and Tourism Council, the WTTC, recently published a devastating forecast, warning that Japan is facing the most severe tourism workforce shortage on the entire planet, projecting a 29% labor shortfall relative to demand. You can raise wages all you want, but you cannot hire people who physically do not exist.
That's a good point. The human capital pool is finite. But hasn't the Japanese government been aggressively trying to import labor to solve this? I saw a headline from late December 2025 saying they are expanding the specified skilled worker visa program to bring in over 1.2 million foreign workers by 2028.
They are trying. Just a few weeks ago, on January 30th, 2026, the Ministry of Health, Labor and Welfare reported that the number of foreign workers in Japan hit an all-time high of 2.57 million. But here's the critical data point. Nearly 40% of the hospitality sector's part-time labor used to be foreign students and migrant workers. And right now, that vital labor pipeline is severely compromised by the exact same macroeconomic force that is bringing in the tourists, the extremely weak yen.
Okay, wait, so the weak yen makes Japan incredibly cheap for American and European tourists, but it simultaneously makes Japanese wages virtually worthless for foreign workers who need to send money back home to places like Vietnam, Nepal, or the Philippines.
Exactly. For a worker from Southeast Asia, a Japanese salary paid in yen has depreciated massively against their home currency over the last few years. The very macroeconomic force that is causing the unprecedented demand shock from tourists is actively choking off the only viable labor supply. They're looking at the exchange rates, packing up and going to South Korea, Taiwan, or Australia instead, where the wages are significantly stronger and the currency is more stable.
That is a brutal catch-22. So if you literally cannot import enough human labor, what is the ripple effect on the broader travel ecosystem? Do hotel operators just lock the doors and leave half their rooms empty during the peak cherry blossom season?
They have absolutely no choice. In fact, I was just reading this morning that JTB, Japan's largest travel agency, released a very sobering industry forecast in January 2026. Despite the government aggressively targeting 60 million visitors by 2030, JTB warned that inbound numbers might actually plateau or even decline slightly this year to around 41.4 million, and they explicitly cited severe labor constraints in hotels and flight operations as a primary bottleneck preventing further growth. Japan is literally turning away billions of dollars because it cannot physically accommodate the guests.
That reminds me of what happened in 2022 when the global supply chain completely broke down. Consumer demand for electronics and goods was absolutely off the charts, but the physical ports just couldn't process the cargo ships. Here, the cargo is tourists, and the ports are the hotels, restaurants, and regional airports. The infrastructure is hitting a hard physical ceiling.
Precisely. And that physical ceiling is triggering the second massive ripple effect, a desperate forced pivot into hyper-automation. Historically, the Japanese hospitality sector has prided itself on omotashi, this highly personalized, human-centric, meticulous customer service. But right now, they are being forced to abandon that legacy model and buy up B2B robotics and AI solutions at a staggering pace.
Right, we've always seen those quirky YouTube videos of the robot dinosaur front desks in Tokyo, but you're saying this is no longer just a PR gimmick to amuse tourists?
It is pure corporate survival. If you look at HCJ 2026, which is the massive hotel and restaurant industry trade show happening at Tokyo Big Sight literally right now in mid-February 2026, the floor is completely dominated by AI and automation vendors. You have companies like RoboPath showcasing multifunctional service and delivery robots, and their booths are packed with desperate hotel managers. We're talking about automated multilingual check-in kiosks, generative AI concierges, and back-end predictive maintenance systems that shrink housekeeping schedules.
So the real winner of the 2026 Japanese tourism boom isn't necessarily the hotel operators themselves, because their revenue is capped by their inability to staff rooms. The actual winners are the B2B logistics automation and hospitality tech companies selling these digital workers.
Exactly. The B2B hospitality tech market in Japan is experiencing an absolute gold rush because a cleaning robot or an AI multilingual chatbot doesn't care if the yen is trading at 150 to the dollar, and it certainly doesn't need a specified skilled worker visa to operate 24/7.
This is a perfect storm for the automation vendors. But let's step into the contrarian corner, Alex. The entire consensus right now, and you just outlined it perfectly, is that Japan's severe labor shortage in the hospitality sector is an existential crisis, a massive loss of potential GDP, and a desperate struggle to replace missing humans with robots. What is your contrarian view?
My contrarian view is that this acute labor shortage is the greatest long-term structural gift the Japanese domestic economy has ever received. The consensus thinks the lack of workers is destroying the hospitality sector. I think it is the only force powerful enough to permanently eradicate Japan's chronically low-margin zombie service businesses.
Wait, really? A gift? You literally just cited a record high of 397 labor shortage bankruptcies in 2025. You said the nation is turning away billions of dollars in peak tourism season. How on earth is an inability to operate a hotel a structural gift for the economy?
Because the Japanese service sector has historically been an absolute graveyard for productivity. For decades, companies survived by deploying an endless army of cheap part-time domestic labor to provide meticulous but entirely unscalable customer service, the famous omotashi. They artificially kept prices low by exploiting demographic stagnation.
Okay, but devil's advocate here. Isn't that meticulous high-touch service exactly what tourists from New York or Paris are flying to Kyoto to experience? They aren't going to Japan to interact with a QR code or an iPad. They want the traditional ryokan experience with 5 staff members bowing at the door. If you automate that away, don't you destroy the very product you're selling?
Well, actually, let me rephrase that. I'm not saying the ultra-premium luxury ryokans will automate. The Aman or Hoshinoya resorts will continue to charge $2,000 a night and pay top-tier wages to retain human staff. They have pricing power. The problem is the vast, bloated middle tier of the economy, the thousands of regional 3-star business hotels, the low-end chain restaurants, and the fragmented paper-based logistics companies.
The companies that have barely survived on razor-thin margins and cheap labor since the 1990s.
Exactly. The labor shortage is finally forcing these inefficient, low-margin zombie companies into bankruptcy, which is a brutally necessary creative destruction. The workers and capital freed up from those bankruptcies are being reallocated to the companies that are actually investing in AI, robotics, and aggressive wage hikes to capture the massive inbound demand.
That's a good point. So the labor shortage is effectively a Darwinian tax on low productivity. If you can't afford to automate your back office or pay a competitive global wage, you simply do not get to participate in the 10 trillion yen tourism boom. You die, and a more efficient operator takes your market share.
Precisely. For the first time in modern Japanese history, the power dynamic has completely inverted from the employer to the employee. Look at the preliminary numbers for the Shunto, the 2026 spring wage negotiations. Major corporations are already agreeing to historic 5 or 6% baseline pay increases just to prevent their workforce from jumping ship. The labor shortage is physically forcing inflation and wage growth into a notoriously deflationary economy, something the Bank of Japan has been desperately trying to achieve with zero interest rates for 20 years.
That is a phenomenal reality check. The labor shortage isn't the disease, it is the violent structural cure for decades of economic stagnation. But if this massive consolidation and automation wave is happening right now, how do global investors actually navigate this? Where is the real money flowing in this demographic transition?
To navigate this massive demographic transition, you have to look past the headline tourism numbers and focus on the companies physically replacing human labor. Here are 3 specific action items for investors dealing with this labor shortage paradox.
I have my notepad ready. How do we play this friction between infinite inbound demand and zero domestic labor supply?
Action item number 1. Go long on Japanese B2B hospitality tech and automation solution providers.
Right, the companies literally selling the robots and AI systems to the hotels we just talked about.
Exactly. I'm talking about the manufacturers of self-check-in kiosks, multilingual AI concierges, and automated cleaning robotics. While the hotel operators themselves are hitting a hard revenue ceiling because they can't staff their rooms, these tech vendors have no ceiling. They are selling the absolute only viable solution to an existential crisis, heavily subsidized by Japanese government IT grants. They are the ultimate winners of the labor crunch.
When the human capital runs out, the tech companies get the blank check. What is the second action item?
Action item number 2. Invest in private equity or specialized REITs targeting distressed regional hospitality assets.
Wait, buying bankrupt hotels? Isn't that catching a falling knife if there's no one to run them?
Not if you completely change the operating model. Smart funds are aggressively buying up 3-star regional hotels and traditional ryokans that went bankrupt strictly due to labor shortages. They buy the prime real estate at rock-bottom distress prices, fire the inefficient legacy management, and completely retrofit the buildings with the automated tech we just discussed to run them as high-margin, unmanned, or low-staff boutique hotels. It is a massive turnaround real estate play.
That is the literal definition of creative destruction. You merge physical distressed real estate with modern software. Okay, what is the third move? What do we avoid?
Action item number 3. Short or completely avoid labor-intensive, low-margin legacy service companies that lack pricing power and capex.
The zombie companies still trying to operate like it's 1995.
Exactly. We mentioned the Shunto wage negotiations earlier, where major corporations are handing out 5% or 6% wage hikes. These low-margin small businesses simply cannot afford to match those wages. They cannot afford the capital expenditure to buy automation systems, and they have no pricing power to pass costs on to consumers. They are going to lose their staff, lose their market share, and ultimately go bankrupt. They are the absolute losers in this ecosystem.
It's incredibly clear. So the ultimate takeaway for today is this. The collision of 42 million inbound tourists and a devastating labor shortage is not just a crisis for Japan. It is the ultimate structural catalyst. It is physically forcing the bankruptcy of inefficient zombie companies, driving unprecedented wage inflation, and sparking a massive, forced adoption of AI and robotics in a notoriously stagnant service sector.
Precisely. The labor shortage is the only mechanism brutal enough to actually break Japan's deflationary mindset.
Next week, we are pivoting to Southeast Asia. We are going to unpack Malaysia's explosive $50 billion foreign direct investment boom. We'll look at how Penang is transforming into the back-end packaging capital of the world as the global supply chain aggressively pursues a China Plus One strategy.
Back-end testing and advanced packaging used to be an afterthought, but it is now the critical choke point for global AI chip yields. We will dive into the hard data next time.
You definitely won't want to miss that one. Thanks for listening to Asia Tech Macro. Stay data-driven. Bye.